I don't think we're going to see a V-shaped recovery, but once again, you have to keep in mind that for whatever reason, a lot of the world is annualizing the numbers. So, for example, when we're talking of 25 or 30% collapse in U.S. GDP, that assumes that 5 or 6% drop in the first quarter is replicated for 4 quarters, which is clearly nonsense. So if you think on the sort of quarter-by-quarter basis or year-on-year basis, I don't think it's going to be a V-shaped recovery. I think it's going to be a steady progression as we go through the balance of the year. But of course, if you're annualizing, then the numbers will be very erratic and very, very large. I view it as more a steady recovery into the third, fourth quarter rather than the V-shaped recovery.
Victor, for the moment, to what degree do you feel investors are going to even put aside economic data that comes out and going to focus instead on the waves of stimulus that have been coming out? Trillions of dollars essentially thrown at individuals who are starting to get their checks and at the markets here. And so they're desperate to get in if they're uninvested. And the second part of that question is that a wise strategy? Because there is the possibility, of course, that the market could roll over again.
Well, I've maintained for quite some time that essentially public sector over the last 3 decades gradually been muting and eliminating free market signals. What we're seeing with COVID-19 is sort of the final gasp that most of the market and most of the asset prices are now backstopped by central bank, from treasuries and bond market to corporate bonds, increasingly high yield market, commercial paper, mortgages. Eventually, that will translate into equities as well. We're also seeing increasing cooperation of fiscal and monetary policies. That's been the case for the last 10 years. But what COVID-19 has done is basically accelerated. Now, if you combine fiscal and monetary policy, that's your MMT, that's your modern monetary theory, which means the fiscal pulse is at least 2 to 3 times larger than what it was in 2008, 2010. So from an investor's point of view, in a world where credit is getting nationalized, where most of the signals are no longer driven by free market, where do you position yourself? How much do you anticipate? Do you ignore GDP numbers? Do you ignore earnings per share numbers? My answer is that as we progress through 2020, I think the analysts and investors will ignore GDP numbers and will ignore earnings per share numbers almost entirely. And what they would be hoping for, that as we go into 2021, at least some free market signals will start coming back.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.